Hello, this is Will Allen with Centera Capital. In today's market update, we are going to take a look at the key determinants of inflation to tell us where it may be going in the future. We're also going to look at what the most important variable as related to where the stock market has gone over the last couple of years. Let's dive into it. Now, before we get into the market update, just a reminder to like and subscribe to the channel or share if you have any friends or family members who aren't getting this kind of market updates on a regular basis. Okay, now I want to mention that we had in our last couple of videos talked about the stock market sell-off of about 6% that had been triggered by an uptick in the inflation rate from 3.15% year over year to 3.48%. Now, we had one of our clients who came to us and said, hey, what are the determinants of the inflation rate and where it is going? So we thought we would talk about some of those things and see if we have any clues to where the inflation rate's going to be in the months to come. The first thing that causes inflation to spike, supply chain disruptions. We saw this when COVID hit, right? A lot of supply chains were in major trouble, and we saw the prices of a lot of items go up. The best example of this is in the auto industry. There were a lot of chips that go into these cars that were not being manufactured, and so there was a major shortage. A lot of car dealerships, if you drove by them, you saw there were not many cars on the lot. And so car prices spiked about 50%. Used car prices, for example. So supply chain disruptions pretty much now have kind of gone back to normal. That is not a major concern of where inflation's going in the times to come. Now, another factor is wages, okay? Wages for employees. And we wanted to put up a chart on wage growth year over year because this came out last Friday and this calmed the market. We're going to put it up, and what you will notice here is we have the fact of our average hourly earnings grew at 3.92% year over year. Notice this chart has been going down over the last 2 years from a high of about 5.96%. And when this came out Friday, it was a relief to investors because we got that uptick in inflation to 3.48%. They were worried that wage growth was going to start to go back higher year over year. And when it came in at 3.9, still declining, that was a relief for a lot of investors. That tells us that inflation in the future may continue to or may resume going lower because wages are going lower themselves. So that's point number 2. Let's get to the third point. So in addition to supply chain issues and wages, the third factor that can cause inflation to skyrocket or spike is commodity prices. And commodity prices, we're talking about grains, metals, cocoa, coffee, things of that nature. And we have some positive news here in that commodity prices have not spiked in the last couple months like they did back in 2021 and 2022. One of the areas that affect consumers every day, gas prices, energy prices, and we have positive news here because oil is at a much lower level today than it was a couple years ago. Let's put up the chart. You can see in red there, oil got as high as $123. Okay, just a couple years ago, and at that level, that was causing a lot of hurt for businesses and consumers and retail folks going and buying gasoline. Notice that oil today is at $78.75, much lower than it was just a couple years ago. And this is positive for the path of inflation in the months to come if energy prices stay at much lower levels than they were at just a few years ago. The next factor that plays a big part in inflation is the shelter component. And on shelter component, we're talking about housing prices and we're talking about rents of apartments and of homes. And we wanted to focus because home prices are still, if it's existing homes, they're still flirting with their record highs of a few years ago. New home prices are about 10% lower than they were a couple of years ago. And so that is a positive. But when it comes to rents, we want to talk about apartments. And we're going to put a chart up that shows that apartment rents skyrocketed in the early COVID days. You can see, or at least a month in, this got as high as almost 18% year-over-year increases in what you would pay if you went to rent an apartment. We'll look at what has happened of late. We've basically had about 8 months where rent growth has stabilized at near zero. And so this is a very positive sign. Now, there is another chart we're going to put up that helps explain this, and that is the vacancy rate in apartments. You can see that just a couple years ago, in October of 2021, the vacancy rate was just 3.9%. That is when inflation was sky high. That is when apartment rents were growing at 18% year over year. And the apartment companies could do that because if someone came in and wanted to rent from them, they had such low vacancy rates, it didn't matter to them if that person said, hey, that's too high. They knew there'd be someone else coming in soon that would be willing to pay those rents. Well, now you have vacancy rates back up at where they were 4 or 5 years ago. Thus, the apartment companies cannot have 5, 10, 15% increases in rents. Okay, the final point with regards to inflation that we're going to talk about is the Federal Reserve and their policies and government spending. Now, on the Federal Reserve side, they have hiked interest rates aggressively. Their last hike was last July, and they're now done hiking interest rates. Fed funds rate is up to 5.5%, so they have done their part to bring the inflation rate down. On the government spending side, we don't have as positive of news as these other factors. The government right now in this fiscal year, which their calendar year goes from October 1st through September 30th, right now they're on pace to spend $1.8 trillion more than what they were budgeted for. So again, government spending has been a big problem now with regards to the deficit for 20 years under both Democrats and Republicans. And post-COVID, the spending has been much, much higher than it was pre-COVID. This is something that, again, we'll keep an eye on in the months to come, but we don't expect there to be much improvement here in the next couple of months. What we have hope for, though, is that these other variables we've talked about are trending in a more favorable direction. And if you think about it in a tug of war, what we've seen over the last 6 months is that those sides are winning with the government spending on the other side losing. Now, the final point that we wanted to make today comes around the most important factor, the most important data point over the last 3 years with regards to telling us where the stock market is going to go. And what we're talking about here is the yield on a 10-year Treasury bond, okay? When we say 10-year Treasury bond, we're also referring to this as long-term interest rates, okay? So we just mentioned the Federal Reserve a little bit ago. They have control over overnight interest rates. But with regards to long-term interest rates, that's market driven. And what we've seen over the last couple of years as there's a relationship, and we'll put up the chart, between the interest rate on a 10-year Treasury and the S&P 500, the stock market. Notice there is so much symmetry here. When the blue level, which is the yield on a 10-year Treasury, is going up, the green, the stock market, is going down, and vice versa. And this has been almost in lockstep. There have been a couple times where this has not been the case. The best example, look at June 2024, and look, for about the first 3 months there, both were going up, meaning the interest rate on a 10-year Treasury is going up and the stock market was going up. Well, in the last 4 weeks with this stock market sell-off, their typical relationship has resumed. the 10-year Treasury rate kept going up, the stock market started going down. Now, that is something that we're paying very close attention to. There is some good news here in the last week. We've seen the 10-year Treasury yield go from 4.7%, which was its high level this year, down to, it shows there, 4.58. In real time, this is at 4.49. And the stock market has been able to go higher. It's made back about half of the decline, like we talked about from this recent stock market sell-off. It's made back about half the decline. Watch this number carefully, because in the months to come, if the yield on the 10-year Treasury resumes going higher and goes back up to that 5% level, which it reached back here in October, if it reaches that level again, then it's going to be tougher sledding for the stock market. Meanwhile, if that number stays at 4.5, goes down to 4.25, we can expect the stock market to go back to 52-week highs. All right, in closing, I just wanted to highlight that we are now 80% of the way through first quarter earnings reports. And speaking of 80%, over 80% of companies have beaten their earnings estimates, their profits estimate for the quarter. That is very good news. We've also seen virtually all of the big tech companies beat on their revenue estimates and their profit estimates, and that again has helped the stock market in the last couple weeks as it's recovered from that 6% decline. Well, in closing here from our new studio, our second video, I hope you enjoyed it. We'll be back with you in 2 weeks for another market update. Take care. Hey, thank you so much for watching this video. Listen, if you are new to Centera Capital, you've just stumbled across the channel, you can go to centeracapital.com to find out more about us, and you can go to the contact page and reach out. If you are not getting these kind of market updates from your advisor, we'd love to talk to you. Thank you again for watching. Take care.